The first step in the process to merge the European steel businesses of Tata Steel and Germany's Thyssenkrupp AG has been done today. And to make sense of it and to get all the details, I'm joined by Tata Steel's Group Executive Director, Kaushik Chatterjee. Thank you so much for speaking to Bloomberg Quint. I want to start by asking you about the capital structure of this deal. Can you take us through the key aspects of this capital structure? What is the quantum of the debt that will move from the books of Tata Steel Europe to the books of the joint venture?
So I think before I give you the numbers, I think I would like to state the principle of designing the capital structure of the joint venture. And we were very clear in our mind that we want to create an enterprise which has a sustainable capital structure matched with the underlying cash flows, provides an opportunity to make the critical investments or necessary investments to create value in the company, and has enough headroom for any downside risk going forward. So with that in mind, I think we came about to the frame where we looked at providing about 2.5 billion euros of the senior facilities debt that exist in Tata Steel Europe, which is total about 3 billion euros into the joint venture. And I think that's the contribution from Tata Steel's point of view. And Thyssen would also look at putting their element of liabilities, which is essentially the steel-related pension liabilities and some of the legacy business liabilities, which is close to about 4 billion thereabouts, which creates a capital structure which is based on pro forma EBITDA of about 1.5 billion euros pre-synergy level. If you take the synergies that we are chasing and disclosed of about 400 to 600, we're talking about roughly about 2 billion euros of EBITDA and 6.5 billion euros of debt, so which is somewhat similar to any of the good steelmaking balance sheets that you see.
Now, I want to come to the synergies, but first I want to understand this. According to the timeline that you've currently set out, you're anticipating that the major agreement will take place at the start of the definitive agreement at the start of 2018, and you expect to close the deal by the end of 2018. Now, when will it reflect on the books of Tata Steel Consolidated? Immediately after the deal is closed?
Yeah, so this venture will get its impact on the Tata Steel financial statements on closure.
Okay. Okay. Now, the next question I want is, and you've actually broached this topic during the press conference, is that you've said that this joint venture is not about closure of operations, it's not about jobs. But the fact is that there has been a mention in the press release, the press statement that your partner or your potential partner has put out about the reduction of jobs by 2,000 on the administration side, 2,000 on the production side. You said that that's going to play out after the actual JV comes into play, but there's going to be a pushback from the unions, won't there be? And what is the communication there? Do you see that as a major barrier to the conclusion of this deal?
No. So I think as I still repeat again, that the principle of this joint venture is on the industrial strategy and on the strategic logic of combining number 2 and number 3 in a European market. So it's about creating value. It is about meeting the customer expectations with a product portfolio which is which differentiates with the rest of our peers. We are focused on quality, cost, and technology leadership. So that's the framing, and that's the basis on which this combination has been created. When two organizations do combine, there will have to be a joint business plan or a combined business plan to deliver the desired outcome of this joint venture's operations. That business plan will have to capture how do we together in the venture drive efficiencies across all our businesses. And in that, there will be elements where we will have to address issues like overlaps and duplications and organizational structuring.
So sorry to break you, but so here they've said that it'll be shared equally. They've clearly said up to 2,000, up to 2,000, so 4,000, split equally between Tata Steel and
So it is more jointly rather than equally. And I think the reason why I say jointly, it is not a game of man-to-man. It is a game of where the efficiencies needs to be kind of derived most, where is it best positioned. So that's why I don't want to get into an issue of which partner or which shareholder has to bear what. It is a joint venture which is to be decided. So when the joint venture is formed, it is no longer us and them.
So having said that, the trade unions have put out a statement saying that they're cautiously welcoming the move, which indicates that while it could be positive, they're still waiting for details. So there will be a lot of negotiation that takes place.
There will be, in the time when the MOU has been drafted and negotiated and so on, we cannot go out and do explicit conversations. So as the conversation now moves from the MOU to the definitives, we will, as we have done in the past, taken people along, explain the strategic logic, define the business case, and looked at providing them with a very transparent rationale of what we do. So I think it is in our DNA, as well as in, I believe very strongly in Thyssen's DNA, to take every stakeholder along. Okay. And that's what we will do.
Now on the cost synergy part, you said you identified 400 to 600 million euros that will essentially play out through this partnership. When do you expect this to play out? FY20 rather, I would think, because you expect end of 18 is when you will close this deal. It'll take a little time, won't it?
So so that's why I said that it's all part of the combined business plan. So when the business plan is made, there are multiple elements which has to be realized over a period of time. Some of them can happen in a shorter period, some of them may possibly take longer period depending on what that it is. Typical benchmarks are about 3 years. Okay. And I would at this point of time not venture beyond that. Okay,
and on the revenue side, how long do you see that playing out, the synergies on that front? So it would have to do with your plan for 2020, the production network relook that you want to have.
Yeah, so the revenue side is a matter of the JV management to understand how the product mix is going to get enriched as a combined entity, how the technology levels are going to get adapted into a new product development and so on. So this is again an element which the combined business plan has to address, and in addressing that, then they will have to figure out the whole customer relationships, the market interface and so on, and then look at how it works.
But primarily flat products is what we're looking at?
We are only flat.
So only that's what I'm saying. When Absolutely. You're saying product development, it's going to be only
flat products.
Okay. Now finally, on the India side, you said that this joint venture will essentially allow you to free up a lot of sort of planning power, so to speak, with regard to the Indian business. You want to double capacity. Over what period of time are we going to see this, both inorganic and organic growth?
So I think we have said that as the first priority will be to look at aggressive growth in principle. That will certainly manifest in terms of organic growth. We surely have our plans in place for Kalinganagar's next phase. We will take it up with our board and have that conversation in short time. There is potential growth even in Jamshedpur. We will have to look at all the elements of that. And then there is an opportunity perhaps to play in the stressed assets process that is currently unfolding. We will have to look at the fitment of strategy, quality of assets, the value of synergies and so on, and then decide which is it that works best for us and look at taking positions on them.
Absolutely. I'll leave it at that. Thank you so much for speaking to Bloomberg Quint. It's been a pleasure.
Thank you very much.